Welcome to Introduction into the Market 102. We're going to go over different types of orders, longing and shorting, just a brief overview. So if you think that Tesla is going to go up, what you're going to do is you're going to buy Tesla. And so all you do is you put in your ticker, Tesla, and it's going to tell you what it's trading at. And you've got different choices to say, you know what, I'm going to place a market order, a limit order, and I'm going to tell you a little bit about what those are. Limit order means that you're not going to pay more than this amount. So if we come back over to the chart and you're like, you know what, I think Tesla's going to pull back to, let's say right here, 674.11. Well, you'd say, you know what, that's where I want to buy. And so you would put in 674.11, and you'd put how many shares you want. Let's just say 1,000, and then you would come over here and you would hit buy. What will happen is once Tesla gets down to 674.11, you will get filled with your 1,000 shares. If it never gets down there, you will never get filled. And this term is just for the day. If you want it for a good till cancel, all you do is just hit good till cancel. That's GTC. Okay. This one is fill or kill. It needs to be filled quickly or it's going to be killed. And then for shorting, if you think it's going to go down, you would do the same thing. But let's say you don't want to short it until it gets to 700. You'd come over here and you'd put that in, and then you would hit short. Now, let me explain just a quick difference between shorting and longing. If you short a stock, you have unlimited risk. What that means is if you short a stock at $1,000 and it goes to 10,000, you've lost way more than 100% of what you originally invested in, right? It could go to $1 million. But if you invest in a stock that's in 1,000 and it goes to 0, the most you can the most you can lose is what you invested. Now, that's what people say to scare people away from shorting. And it is very dangerous and can blow up in your face. As a good trader, once you learn how to stop out and take your losses, shorting is no more risky than longing because you're going to obey your stops, right? So that's a little bit about shorting and longing. There's some other orders that you can put in. They're called conditional orders. Conditional orders, you can see contingent, one cancels all, one triggers all, or other cancels other. So for example, what I'll do is I'll say, you know what, if Tesla hits a price greater than or equal to, let's just say 1,000, well, I want to be a buyer. I want to be a buyer if it hits that. So I would come down here and I'd put in Tesla, and I'd say, okay, I want to buy Tesla, 1,000 shares. And if it hits 1,000, I think it'll pull back to 995. I can get in there and boom, there we go. So that's a contingent, right? And then one cancels all, you can come in and say, if one of the orders in the group triggers, cancel all the other orders. Well, let's say you own 1,000 shares of Tesla. Well, you don't want Tesla to go below a certain level, and you want to sell if it gets to a certain level. So let's say you want to sell it. Let's say right now it's at $700 and $706.98. Well, you want to sell it when it's at $750. So you'd put in a limit order to sell at $750. Well, if the other thing that you wanted to do was, you know what, I don't want this to go below a certain level, you can put a stop on quote, a stop limit on quote, a trailing stop. Yeah, we need to put selling here on this side right here for order type. And let me explain a little bit of the difference. So a stop on quote just means, you know what, we hit this price, we're out. So let's say we don't want it to go below 650 or 675. You put that in there, right? And then it's going to sell it at market. Stop limit on quote would be once it hits this price, you put in whatever your limit is. If you don't want it to sell for under 670, then there you go. It would sell at worst at 670. If you wanted to do a trailing stop on dollars, so if Tesla went up to, let's just say 749, But then it comes back all the way back down to 700 where you bought it, and you're like, well, crap, I should have sold. You can put in a trailing stop, and you can say, you know what, let's go trailing stop for $5. If we go $5 backwards, I want to get out. Well, what that means is if we go to 730 and then down to 724, you're going to sell, right? Because we dropped $1. So you have to decide on the amount you want, or you can go into a percent, right? A percent value to get your trailing stop. And you can do this. You can do this on any order. It doesn't have to be a one cancels all. You can just do it on a regular order, all these trailing stops. But this is just an example of a one cancels all. Whichever one hits is going to trigger, and then you're safe. One triggers all is very different, because what you can do is you can say, you know what, if you're playing a fast moving stock, let's just say ABIO, and ABIO's pumping it up today. They're a pump and dump company. Well, ABIO, you buy 1,000 shares and you're going to buy it at, let's say, 434, but as soon as you buy it, you want an immediate stop to be put in, so that if it goes against you, you want to sell it. Same thing, right? Hidden, a lot of times hidden stops don't work on these, but same idea. So you'd put in a stop on quote, a hidden stop, trailing stop, etc. You'd put in your stop here, and let's just say it's $4.15. So if I buy that, as soon as I buy it, immediately it's put in for stopping out at this level, right? So it's like, once this order executes in full, right here, boom, this order is placed, right? And what you can do is you can set up another one, right? Place this following order. And you can also set up a one triggers an other cancels other order, which is right here. And what that means is, once ABIO, you know what, I'm willing to take you at 434. I want to sell you at, put in all the tickers here, I want to sell you at $5, or I want to stop out at $4. All right, so boom, you put in $5 limit order, and then you'd put in a stop on quote at $4. You hit submit, and then boom, your order is in. You get filled. You are going to immediately place a one cancels other order. And so as soon as either $4 gets hit, you're going to get stopped out, or $5 gets hit, you're going to take your profits. Okay, that's your one triggers other cancels other order. Now, when it comes to options, you can do the same thing with options. You just have to change it, right? Option over here and options over here. It's the same idea. And so it's coming in and saying, you know what, conditional, total trade ticket. There's a bunch of different things that you can set up as far as options. It's a big rabbit hole, and we'll go down that rabbit hole a little bit later. Just to give you a quick overview, if you wanted to do a call, covered call, it's going to give you the ability to put these all together in one shot. So if I wanted to do a covered call, I'm going to buy 100 shares of AMD. It's automatically going to change that to 1. And so I'm going to sell, let's say I buy AMD 100 at market. I'm going to sell my March 19th call at 85. Well, that's going to tell you I'm going to get, what is that, 66 cents for this call. I'm paying 82.70 for AMD, and that's going to tell you your total ticket, and boom. And you can add another option leg, et cetera, et cetera. But that's the basics of types of orders that you need to know. And the most important thing to understand is risk management. You never want to put on a trade without understanding where you're going to get in, why you're going to get in, where you're going to get out, why you're going to get out, and where your stop loss is. All right.